Good morning. Today is Wednesday, June 8th, 2022. We are from Merida Country Club. We have a Narwhal event here today, internal event. So we're going to be here with a bunch of meetings. We have Tom here currently live on set. We have Natalie here who's just setting up, and I'm sure there'll be other people filtering in. So just bear with us as we go through that. One piece of big news that we will not be talking about because we do have a couple former interns who are working there is Credit Suisse just actually announced their third downgrade to guidance this year because it's just a very poorly run kind of investment bank, and they're seeing a lot of demand dry up for their credit. But we're going to jump in, Tom, and talk a little bit about what we saw yesterday from Janet Yellen and what we can expect today, because she's actually going to continue to testify in the House of Representatives. But yesterday she was in front of the Senate committee. So Tom, take it away. She said, talked about inflation.
Yeah, so there wasn't a ton of takeaways. I missed it in real time, and I watched again last night. So just know that we're out here grinding for you guys, sitting through boring stuff, even after hours. The big quotes that came out of it were that she said, quote, "I do expect inflation to remain high, although I very much hope it will be coming down now." Which is high and going to probably stay there. Basically way is sort of a read through on how Treasury Secretary, someone at the highest levels of our government, is looking at inflation. The hope that it might come down is really where we are. She also said that, quote, "It can't be the case that the bulk of the inflation that we're experiencing reflects the impact of the American Rescue Plan." Now, I'm not sure who wrote that line for, but I have my suspicions. I think that that's very much along the party line, which is basically saying that this is a result of the war in Ukraine and supply chain issues, and not at all for the fact that we spent $2 billion and put it in everybody's pockets, and suddenly people bought a lot of stuff, which pushed prices up. Notable thing, she also said ways to ease inflation, raising the interest rates, which the Fed is actively doing, lower the cost of prescription drugs. If we did that, that would definitely filter through CPI, as healthcare costs are definitely in there. Incentivizing clean energy production, which I'm not sure exactly how that works in terms of reducing inflation, but that seems to be something that is a talking point nowadays. But I think it's going to be far more expensive to put that in place than it is not to, at least in the short term. And so, they're not saying, hey, we're going to tap the Keystone Pipeline again and get oil flowing and drill everywhere. They're saying, hey, we're going to work on a potential 15 to 20 year project to get green energy off the ground, kind of regardless of what gas prices are doing. And the last one would be bolstering semiconductor manufacturing, which has already been in process, and we saw a lot of problems with the supply chain. And so there's plenty of that going on, but the lead time on that is going to be pretty extensive, I believe. So we're probably going to see the effects of that in a few years. And my expectation is what you see a lot with semiconductors is there's a shortage, overproduction, and then the cycle will collapse and we'll see semiconductors really come down. But I don't think we're quite there in terms of that cycle yet.
Yeah, I think what you're talking about, Tom, in terms of what Janet Yellen said yesterday, and she's thinking that she hopes that inflation will be coming down. She talks about Fed raising interest rates. She talks about prescription drugs. We know that's going to take a long time if it happens. We're talking about incentivizing clean energy production. That's going to take a very long time. Bolstering semiconductor manufacturing is going to take a really long time. So I think all of these things could just kind of highlight to me the impotence of the Fed the federal government to really actually act here. I think the biggest thing that could help in the near term is reducing freight costs, which means reducing diesel prices, which means reducing oil prices. But that is antithetical to a lot of the goals that want to get accomplished by the federal government right now. So it's going to be tough to get to a point where we're actually really taking inflation down meaningfully. And I think that Janet Yellen, was kind of shown to be that yesterday. And I expect more of the same today, except I actually expect a few more fireworks, given that it's going to be in front of the House rather than the Senate, which tends to be a little bit more staid. There was a 3-year note auction yesterday. That was relatively soft. Rick Santelli over on CNBC gave it a C-. There just wasn't that much demand. We did talk about this is the beginning of quantitative tightening, which means that the Federal Reserve is not rolling over interest payments and principal payments into new issuance. What it is doing is just letting that roll off, which means that holders of previous 3-year notes will not be buying the current 3-year notes. And that's going to be the same for the 10-year note auction today, Tom. The question is, will this lack of demand continue, or is this just a testing out of the waters where a lot of buyers who might have come in originally wanted to steer clear of a potential Fed-induced blow up on the auction?
I think it's kind of hard to tell. The data really didn't play out in a way that was easy to determine exactly what was happening. I would say it's sort of a mix. There's going to be the normal people who will be buying 3-year treasuries are probably avoiding it because they know that there's a double hike coming next week, and that's definitely going to affect the short end of the curve. Additionally, there is not that giant buyer, the giant gorilla buying up all the paper that is the Fed. It has been the Fed, is not there. But the tail on the auction was relatively small. It wasn't a disaster. I mean, if it was a grade, I think Rick Santelli gave it a C-, so you're still passing the class. It still got off without a hitch, but it wasn't a disaster. And so I think it's a little bit of everything. But demand is still relatively strong given all of those different factors. I think that a C- is okay. The 10 and 30 year, I think, are going to be a little more telling. They're less affected by the Fed. They're typically much larger issues. So really what we're going to see is are there going to be a lot of indirects? Are there going to be a lot of foreign buying? How big are the tails? Because I think if we get a couple really bad auctions this week, it could be pretty tough on bonds, though we have seen a marked bifurcation of sort of the bonds that we own. Munis are doing very, very well the last couple of weeks. Treasuries are not doing so well. So we've seen a split there in terms of performance, which is encouraging. Taxable munis continue to be much maligned. There's an article on Bloomberg this morning saying that people need to start buying taxable munis because they're so cheap and so clean, which we've been doing, but has not been playing out just yet. And it's going to be a bumpy week because at least we get the auctions before CPI. If it was after, who knows where that's going. But I think that we're probably going to see some pretty soft demand. Maybe a couple more C-, if not one of these auctions going poorly. And if CPI is above expectations, then if you got in, you're probably going to lose money either way. And so the demand, I think, is going to be driven by that as well.
At the end of the day, investors don't want to fight the Fed, which basically means in this case, don't buy treasuries and don't buy mortgage-backed securities, because that is the way the Fed is flowing out of things. Now, you can buy munis, you can buy taxable munis. You have certain supply there, supply that's relatively small compared to the treasury market, compared to the MBS market. So that is where we are looking for opportunities, and that's where we can have some handle on supply-demand balance there. Next story we have is the FTC is probing pharmacy benefit managers. Pharmacy benefit managers, the big three are UNH, which owns Optum, Cigna, which owns Express Scripts, and CVS, which owns Caremark. These are the consummate middleman. They negotiate drug prices. They operate in between the insurance company and the drug manufacturer. So they negotiate all those prices, and then they take basically take a percentage of that. That's one of the metrics that we look at when we look at that. Now, obviously, if you're getting a set percentage of a number, you want that number to be as high as possible. So the concern in pharmacy benefit managers is that they don't really have as much incentive to negotiate down drug prices. Now they are owned by payers now, which kind of helps. CVS merged with Aetna, which is a payer. Cigna is a payer. United Health is a payer. Nevertheless, all these companies get paid based on margin because they are essentially regulated monopolies. And that means that when you have a set margin, you want the dollar value to be as high as possible. So how do you get the dollar value as high as possible? Make the cost base as high as possible. That's the business model of these companies. Now, we've looked into this number of times. Every administration tries to crack down on PBMs. It just doesn't happen. I expect that these companies will emerge just fine. The FTC probe seems relatively small compared to past probes that we've seen. They're just asking for records and other information about their business practices. So I don't think there's going to be a whole lot there. It's not like this is a DOJ investigation or anything like that. Tom, any thoughts on the PBMs?
Yeah, I think it's a shady business. Everybody knows it. I think that this is probably at least a stab at jumping in with Janet Yellen saying we're going to bring drug prices down. Honestly, I think the free market's a great way to do it. There's Mark Cuban owns a company called, I think it's called Cost Plus Pharma or Cost Plus Drugs, where it's an online pharmacy where they just do whatever the cost of the drug is, marked up 15%, and that's what you pay. And I think it's got legs. I think that's an interesting way to attack it and kind of a way to combat these consortiums. But at the end of the day, people don't know about it. It's sort of a new business, but I think that's kind of the way it has to be done. Is that there's going to be some players who come in and see that this model is ripe for disruption, but they've got so much market share that it's going to take a long time for it to rectify itself. But I think that's really the best way to do it.
Taiwan Semiconductor raised guidance today to 30% from an April expectation of mid to high 20s. So they're starting to get their production amped up a little bit. What's really driving their demand is producing chips for electric vehicles. They are seeing significant weakness in smartphones and computers and PCs. We know that's been the case. That's not a surprise. Taiwan Semi says that they're more than making up for it with other areas like EVs and like other industrial components. And again, that's not surprising. I think that semiconductors will continue to be supply constrained. And as Taiwan Semiconductor is the largest third-party fabrication facility and company in the world, I expect that Taiwan Semi is going to continue to basically sell as much as they can produce over the next 12 to 18 months. Tomorrow we have Signet earnings. That'll be an interesting read on the discretionary spending and the will of the consumer to continue to spend. I actually think that Signet could perform quite well, although you have to be worried a little bit about a head fake there. You have the ECB meeting, Christine Lagarde potentially talking about raising rates. Initial jobless claims tomorrow. We haven't seen a tick up yet, but we have seen more anecdotal announcements of people laying off workers. Last month, we did see a big decline in small business employment, which implies layoffs. And we have heard anecdotally that these higher mortgage rates are just roiling the loan origination space, where people are going out of business. And no one's really talking about that, but there are people going out of business, people who were doing very, very well just 6 months ago. And then we, of course, have the 30-year bond auction, and that all leads up to the CPI print tomorrow, Tom, on Friday. What are you looking at, Tom? And then we'll get out of here.
I mean, the Signet earnings is definitely interesting. The wedding industry obviously was beaten up quite a bit during the pandemic, but it's a big company that's really changed their business model. We really have that exposure to them primarily through their very short, high yield bonds, which we have done a lot of credit work on and determined that we feel that they're very comfortable from a credit standpoint. However, if there is a stumbling block there, that could be a potential issue if the wedding market is slowing down. If diamonds are not so much forever, it could be a bit of an issue. But I don't expect that to be the case. They've executed extremely well, especially compared to other sort of mall-centric businesses over the last couple of years, and their bonds have performed outstanding for what they are. I mean, high yield bonds have just gotten absolutely crushed this year. They've held their value very well. They're outperforming the bond market at large and treasuries as well. So knock on wood, looking for good news there. That's going to be a big one. Of course, CPI on Friday is going to be the executioner potentially. So we'll see how that goes. But fingers crossed that we get drops by 4%. Everyone goes back to business and the market rallies 4,000 or 5,000 points.
Thing is, if we go down 4 to 5%, no one's going to believe it.
Yeah.
That's one of the things with the reports that you have to remember is that when these reports come out, if they are not believable, people already know what the numbers actually are and how it's impacting their business. So it is kind of what it is. It'll just solidify it and make the Fed's job a little bit more difficult. That's all I had. That's all we had today. So on that note, we'll let you go. Have a great rest of the day, and we'll see you tomorrow for the ECB meeting. Bye.